Appreciation, Depreciation, Revaluation, and Devaluation of Currency by Pepper and I. For our real-life example, we chose an article on Reuters. The title of the article is China's Yuan Jumps After a Firmer Than Expected Official Fix. Now, let's define some things. A floating exchange rate is a regime where the currency price is set by the forex market based on supply and demand compared with other currencies. Appreciation is an increase in the value of the currency. Depreciation is the loss or decrease in the value of a country's currency with respect to one or more reference currencies. Floating exchange rates, it is important to note, are due to supply and demand, while fixed exchange rates are due to the government changing the value of the currency. A fixed exchange rate is a country's exchange rate regime under which the government or central bank ties the official exchange rate to another country's currency or to the price of gold. Revaluation is a calculated upward adjustment to a country's official exchange rate relative to a chosen baseline. Devaluation is a deliberate downward adjustment to the value of a country's currency relative to another currency, group of currencies, or a standard. These standard could be something like gold, for example. So what does that mean? If yuan had a floating exchange rate, which it does not, this would be the graph. Floating exchange rates can be shown on supply and demand diagrams. We can see on the y-axis, this is just an example, so we're using pounds in relation to euros. On the y-axis, we have the price of pounds in terms of euro. On the x-axis, we have the quantity of pounds. The supply curve is the supply of pounds from the UK. The demand curve is what's changing here. D1 shifts to the right and makes D2. This means that the price of pounds in terms of euro is increasing, and the quantity of pounds available is also increasing. That means that the pound is depreciating, while the euro is appreciating because they're floating, not fixed. A fixed exchange rate. This is an example that I found on XE. It's a great website to see the relationship between two different currencies. This graph shows the relationship between the US dollar and the Barbadian, or Bajan dollar. This Barbados dollar is fixed against the US dollar. So, this is for the last 5 years. You can see here, the Barbados dollar has been 2-to-1 ratio. So, for every 2 Barbados dollars, you could purchase 1 US dollar. This hasn't changed in 5 years, and it probably won't as long as the Barbados dollar stays fixed against the US dollar. This is an example of a floating exchange rate. This is between the US dollar and the Swiss franc. Now, it's important to note that this is just within 1 day. So you can see it might look like the value of the two currencies is changing a lot. However, if you look closer at the y-axis, the bottom of the y-axis is 0.9990 and the top is 1.003. So the value of the currency, even though it might look like it's jumping around a lot, isn't changing that much. Now, over something like a month, a year, 2 years, 5 years, or 10 years, it could change more. But because these both have floating exchange rates, they can appreciate and depreciate against one another and change. So that's what's happening here within 1 day. And this was today. Now, this is what our article is about. The US dollar versus the Chinese yuan. This is over the last week. So you may be wondering, but China's a fixed exchange rate regime. Why is it changing? China's yuan is mostly fixed. However, it is able to fluctuate a little bit. However, if the value of the currency gets too low or too high, the government will interfere. So if you look again closely over this week-long period, the value of the currency is only shifting by about 6 cents. So it's not too drastic, so the government shouldn't intervene. However, if it fluctuates too much, they will intervene. So this is what's relevant to our article and what we'll be analyzing. Next, why did the yuan jump? So the basis of our article, what caused the yuan, the value of the yuan, to jump? So again, China has a fixed exchange rate, so the value can change through the government either revaluating it or devaluating it. It is important to note, however, that because China's is mostly fixed, it can still fluctuate a tiny bit, but not in a significant way, only a couple of cents before the government will intervene. So this is an interesting diagram. This is the price of yuan in terms of dollars compared to the quantity of yuan available by the government. Now you may be looking at this diagram and saying, why are the supply and demand curves shifted? This diagram is showing a shortage. So there's a shortage of the quantity of yuan available due to this fixed exchange rate. So you can see the fixed exchange rate here, the supply, the demand, and this from Q1 to Q2 is the shortage. Okay, the National Congress of the Communist Party, it was on October 18th. They decided when the Chinese yuan value rises, the stabilization of the currency also rises. So they obviously want their currency to be more stable. And now we're going to go into why that is. What are the advantages and the disadvantages of having a fixed exchange rate regime? The advantages. Demand will stay high because supply is limited. The value of the currency will not fluctuate. In a fixed regime, people will be more likely to invest when the currency is stable. People aren't going to want to change their money into a currency if in a couple of days or a week that the value of their money will depreciate significantly or be devaluated. So they're gonna change their money into a stable currency. A stable currency will also keep inflation low and have a positive effect on the current account. That one's super important. Now, the disadvantages of a fixed exchange rate regime. There's less flexibility to cope with shocks, such as a deterioration in the current account balance of payments. Contrary to the advantages, it will cause an imbalance in the current account. And it can be difficult to keep the value of the currency if it begins to slip. So China will struggle with that. If the value of their currency begins to slip too much, then the government will intervene if it's fluctuating too much. But it's hard to bring the value of the currency back up after that starts to happen too drastically. So that's why the government in our article got involved, because the value of the yuan was changing too much. So they wanted to get involved before the value slipped too much and it became less valuable. So now we're going to analyze the article further. So the value of yuan has been fluctuating and the government is stepping in. They're reevaluating the currency in order to make it more stable. Here's a quote from the article. So separately, the governor of the central bank told Chinese business magazine Caixin in an interview late on Monday that China would continue to reform its foreign exchange rate mechanism while relaxing capital controls to allow use of the yuan to be gradually freed. So this will have a positive effect on the value of the yuan. And that's basically the sum up of the article. The Chinese government is going to reevaluate their currency to make it stronger because the value is slipping. And they want, if you see here, they want to raise the value, so they're going to make this currency more stable. Thanks.